Capital B shareholders approve up to 120 buys for Bitcoin buying. Capital B, the Paris-listed firm formerly known as the Blockchain Group, told markets that its shareholders approved up to $120 billion in financing capacity to fund the company's Bitcoin accumulation strategy. The disclosure came via CoinMarketCap on June 19, 2026, citing the company. The vote stands out less for the strategy than for its scale and timing. A $120 billion authorization is not a purchase. It is a ceiling, a standing mandate that lets the board raise capital through equity and debt instruments over time and convert the proceeds into Bitcoin without returning to shareholders for each tranche. Strategy: the Michael Saylor vehicle that pioneered the model in the United States built its position the same way. Serial capital raises feeding a single asset. A European balance sheet built around one asset. Capital B has positioned itself as the continent's answer to a corporate Bitcoin treasury. The rebrand from the Blockchain Group signaled the shift. The company now exists primarily to hold BTC and grow the amount of Bitcoin backing each share. The $120 billion approval gives it room to keep running that flywheel for years, assuming it can actually place the paper. That last point matters. Authorized capacity and deployed capital are different things. A French-listed company cannot summon $120 billion overnight, and the figure should be read as the outer limit of what management may issue, not a balance already committed. The real test is appetite. Whether institutions and retail buyers keep funding a stock whose value is tied almost entirely to a falling asset. Timing against a fearful tape, the vote arrives during one of the more bearish stretches of the year. As of June 19, 2026, Bitcoin trades at 62,406, down 2.4% on the day and 1.95% over the week. The CoinMarketCap Fear and Greed Index sits at 19, squarely in extreme fear. Ether is at 1687, 3.0%, and the broader majors are red across the board. The contrast is the story. JP Morgan recently noted that Bitcoin had spent 5 months below its estimated $78,000 production cost, and digital credit names have been bleeding, with one Treasury executive calling a recent session the worst day yet for the sector. Capital B is choosing this moment to widen its mandate rather than retreat from it. That is either conviction or stubbornness, depending on where you sit, and the market will decide which over the next few quarters. The leverage question: nobody can skip treasury companies that fund Bitcoin purchases with debt and convertible instruments carry a specific risk. The asset they hold can fall faster than the obligations they owe. Strategy's preferred instruments have already shown the strain, with its STRC preferred touching a record low this month. A standing $120 billion authorization does not change that math. It enlarges it. For readers, the relevant takeaway is what corporate accumulation does to supply. Every Bitcoin that moves onto a treasury balance sheet and stays there is a coin not circulating on exchanges. Sustained corporate buying is one of the few demand sources pushing against the retail sell-off that has the Fear and Greed Index pinned at 19. Whether that demand is enough to offset the mood is the open question. None of this is investment advice. The authorization is a governance ceiling, not a forecast. And a company that can issue $120 billion in paper is not obligated to, especially if its own share price stops cooperating.